Hey everyone, me Kevin here. Boy oh boy, here's exactly what just happened with the Federal Reserve. First off, they gave us the 75 basis point hike, which had a 79% chance, a likelihood of happening, and that's what ended up happening. Jerome Powell talked about starting to significantly reduce the balance sheet and, quote, "We will be looking for compelling evidence that inflation is coming down." This is the second 75 basis point hike that we have had, considered to be unusually large, and Jerome Powell says that, quote, "While another unusually large hike could be appropriate at our next meeting, that decision is dependent on the data that we get." In other words, remember folks, it is currently July. They are off in August, other than going on the TV to blab about blah, 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 keeping inflation expectations low. But they do not have another FOMC meeting until September. In September, we should have two CPI opportunities. In fact, we'll be able to verify that right now by looking at the FOMC calendar and then the CPI calendar. We will probably have two CPI reports before the September meeting, which is September 20th to the 21st, which means we will next be meeting on one of these FOMC reports and news conferences on September 21st. Mark your calendar for that. We have two CPI reports coming out. August 10th, that's Lauren's birthday. Wish her a happy birthday on August 10th. That'll be the July CPI inflation report. And on September 13th, which is before September 21st, which represents the August data set. So we have two CPI reports to go before the next Federal Reserve meeting, and the Federal Reserve chose to only hike by 75 basis points. As a result, the 10-year went plummeting down to 2.765%. Break-evens fell even more, consistent with the idea that the bond market is correct, that inflation expectations and consumer expectations of inflation are plummeting because inflation will likely be coming down in the next 2 to 3 months, which hopefully in the next CPI reports, the next two, we will see that. So that way we could get a soft raise from the Federal Reserve in the September, November, December meeting. Now, the Federal Reserve was extremely clear in multiple instances to argue that the SEP from June was still valid. Now, it is very important to note this is a very big divergence from what we have previously heard from the Fed. When the Fed had their meeting in January, they said, man, if we could go back to our December notes, we would change all of that. In other words, they thought they were wrong. They said the same thing when they came out with the June notes. Boy, oh boy, the March notes were so wrong. Because remember, the summary of economic projections only comes out on average every other Federal Reserve meeting. So we did not get a new summary of economic projections, or SEP. Instead, Jay Powell reaffirmed this SEP rather than giving us some vague, oh yeah, it would be worse this time. He didn't say that. He actually softened his statement by saying that, what we said in June is pretty much accurate, which means that the Fed expects to get the rate, or Fed funds rate, to about 3.4 to 3.5% by the end of the year, which implies we have 1 to 1.25% to go. 1 to 1.25% to go could literally be a 0.75, a 0.25, and a 0.25, or more likely, if we get any kind of softness in the data, something like a 0.5, which would bring us to 2.75, 0.25, which would bring us to a 3 point even, and then a 3.25 on the next 0.25 basis point hike. So really, we don't really need these 75 BP hikes anymore. I believe that by Jerome Powell reaffirming and revalidating this SEP, he has basically taken 100 and 125 or any form of rug pull and said, no chance, baby, no chance. The only chance you got is that you got the best chance right now to get the best deal on Kevin's programs on building your wealth, which have a coupon code expiring on July 28th, because then the price goes up as we add more value and more content. But folks, this SEP really important, and it is the first time Jerome Powell has actually reaffirmed one of these SEPs in a very long period of time. In addition to that, Jerome Powell also changed the first line of the statement. Usually, the first line of the statement suggests that, hey, following a brief decline in the first quarter, we've seen a meaningful progress of economic conditions. But instead, what did we get this time, folks? We got the following as a very first frickin' sentence, which, if you are a YouTuber, you will appreciate the following statement. Right here, at the first sentence, you have 99% retention. right here, or about, almost halfway through, you have about 45% retention, and over here, you've got about 23% retention. Okay, so Jay Powell and the crew, they know that they're most likely to have most people read the first sentence, which is recent indicators of spending and production have softened, which is basically the Fed saying, hey, what we're doing is working. Hey, but in the meantime, we still have the JOLTS indicator that's pretty damn strong, which suggests that there are 1.9 job openings for every single unemployed person. And hey, keep in mind that as long as we average 2% over the long term via flexible average inflation targeting, also known as FATE, we're Gucci. So it's okay if we had a little bit of high inflation as long as we can end up averaging 2% over the long run. But folks, we had some really big bangers today, like some juicy bangers today. In addition to the first statement changing, this was probably one of my favorite statements right here, although there's some more juicy ones. Folks, Jerome Powell said the following about getting to neutral. He said, getting to neutral is important. I think we've done that now. 2.25% is where we are now, and he believes that is roughly the neutral rate. Now, Jerome Powell does believe it is appropriate to go slightly above neutral to tighten monetary and financial conditions appropriately. However, he believes we are presently at neutral, which neutral is where we expect to go back to after these rate hikes complete and inflation ends up proving to be transitory. Okay, you can watch the full live stream that I did at the beginning, the first 20 minutes or so when I talked about transitory inflation, if you want to dispute that. But anyway, Jerome Powell did do something that bothered me a little bit again, but he's been kind of, he's kind of been pretty typically doing this lately. At the beginning of the year, he's like, oh yeah, we look at core CPI. Don't worry, we don't look at anything other than core. Then, in the last meeting in June, so this was like in January, okay? Then in June, he's like, oh no. We look at headline. We just look at all CPI. And now, here in July, he's like, well, actually, we look at both. So if you're trying to figure out what the hell he's looking at regarding inflation, he don't even know, okay? He don't even know the answer. And that's fine. That's fine. As long as it all goes down, we're good. Now, he was drilled multiple times about his definition of a recession, and every time he was asked, he says, we think it's necessary for growth to slow down, we think we're coming off high growth that we had during the reopening year of 2021, and that you are seeing tighter monetary conditions which could have a lagging effect on the economy, especially with softening labor numbers coming in. But Jerome Powell, as expected, completely blew off the definition of inflation and completely ignored the question of Biden's redefining of a recession. He says that he's not trying to trying to put us on the path of a recession, and that he's really not going to comment about whether or not we're in a recession or not, because while he'll look at the data, he doesn't really care. Okay, fine, whatever. He does believe, however, that acting too slowly is a danger, because if he acts too slowly, then inflation could become entrenched. Fortunately, he does say, though, that inflation does not seem to be becoming entrenched because break-even rates are coming down. This is a very, very critical argument that I have previously made many times this year, and was actually one of the reasons that I sold in January, because these break-even yields were skyrocketing. But generally, break-even yields, as shown on screen now, generally break-even yields precede inflation coming down. They also generally go up before inflation goes up. So break-even yields are a really good indicator because the market is telling you what they expect that CPI will be. And right now, the expectation is that that is going to plummet. At this last reading, when I took this screenshot, it was sitting at about 2.6%. Now, that doesn't necessarily have to align exactly with CPI. It's really the direction that you're looking at. And the fact of the matter is the direction is the lowest we have seen in literally the last 12 months. That means the market has had lower inflation expectations at no point in the last 12 months. Put another way, at every other point during the last 12 months, we have had expectations that inflation would be worse rather than better. And so this is good. We're in a very good position right now. Now, he does again say regarding the hiking pace that we're going to watch the data for September, that we do think that demand is moderating. This is good. This is him saying that, hey, if demand is moderating, our work is working. So he's telling us that the economy is softening. He's telling us that demand is moderating. He's telling us that he's going to wait for the data. And he's telling us that he believes that there are lagging effects of monetary policy. I don't know about you, but I don't think he could be any more freaking clear that we're probably not going to get anything more than a 50 basis point hike in September, unless, of course, there's some kind of crazy data that comes out. So why are we seeing a rally in the NASDAQ and tech right now? Because the NASDAQ and tech probably bottomed last month. And if you've been sitting on cash, I don't know if there could be any better of a sign to go buy. Although then again, I've said that before and things have gone lower. So no guarantees. I ain't your financial advisor and I ain't responsible for you losing money, just like I'm not responsible for you making money. Although if you want to send me a 10% commission of any money that you do make in the market, any market it is, I'll take it. But let me put it this way, nobody ever does. Okay, so continuing on. Regarding QT, he actually thinks markets are fully accepting of quantitative tightening, which is very interesting because the more we tighten, the more demand the Federal, or I should say the more supply the market puts on, or the Fed puts on the bond market, which means yields go up. And we're actually seeing yields kind of soften. We're seeing break-evens come down, and Jerome Powell gave us zero mention of the forward 3-month Treasury, and nobody asked about it, which was really kind of shocking. Regarding unemployment, Jerome Powell almost verbatim copied my video this morning about inflationary pressures coming down if job openings come down. And he goes on to suggest that if the pandemic caused the labor market to move up, then you should see it come down soon, which means we don't actually necessarily have to rug pull markets to see it come down, because in time it will come down, because it was the temporary effect of the pandemic propping it up. He does see that potentially lower wages suffer the most during inflationary times, although this morning we also made a video suggesting the data shows that lower incomes are actually the ones seeing the highest wage increases. Maybe they're actually not having the biggest burdens in terms of needing to slow down spending. Although, yeah, usually food and gas prices and rents are most felt by those in the bottom quartile of incomes. And ultimately, I have to say, if I were bullish on anything at this point, it would be tech, and honestly, potentially, real estate stocks. Hate to say it, but it's true. Anyway, thank you so much, Odani, for the $10 commission. Thank you so much. Hope to see you when the program's on Building Your Wealth, because we're going live in the course member live stream right as I end this. Thanks so much, and we'll see you in the next one. Good luck, everybody, and enjoy the tendies. Goodbye.